As always, thank you to FX Street, and obviously thank you for your patience while we just sorted out the sound issue, getting things up and running. Going to be talking about a few things today. We're going to be looking, I want to review the price action sequence and also just highlight a little bit of a twist on it at the end and try and take into account basically a failed bias change and trying to identify that at its earliest possible location. I also want to talk about some alternative uses of fib retracements, or alternative to what I would normally use for fib retracements, to try and take into account some retracements that might happen while you're away from the computer or while you're away from your trading machine, and potentially take advantage of some of these overnight or Asian session retracements that we're seeing quite a lot of at the moment. So that's the two main things that we want to go through today. And if we've got any further time, then we'll go through some analysis, and obviously we're going to be looking at some practical applications of this. So the price action sequence, again, I'm going to gloss over it. This has been covered a lot of times in the past, but essentially the price action sequence, as I refer to it, is trying to identify which phase the market is in. When price is making higher swing highs, higher swing lows, it's going up. When price is making lower swing lows, lower swing highs, it's going down. And when it's doing neither of those two things, it's going sideways. And what I also want to include onto that is when price is actually potentially triggering a new direction bias, but then flips back over straight away. So we're going to be looking at the earliest stages of when that potential bias change might actually void. So, quick illustration then. So just starting off on the left-hand side of the chart, swing highs and swing lows. These are the things that I want to try and identify. So for me, a swing high is a bar preceded and succeeded by lower bar highs. It's a 3-bar combination. Obviously the vice versa for a swing low. A bar preceded and succeeded, a bar preceded and succeeded by higher bar lows. So again, 3-bar combinations. Now the swing low can have an equal low, so the full definition is a bar preceded and succeeded by equal or lower highs or equal or higher lows. So with that definition in mind, I can then start to count the swing highs and the swing lows. So starting off on the left-hand side of the chart, we've got swing high, swing low. We've actually got an outside bar here, which is a lower swing high. So we've got swing high, swing low, swing high, again swing lows, swing highs. I'll just mark a few off just to give you the illustration. Swing highs, swing lows. So at this stage of the game, it doesn't really make much sense until we start to label those. So we've got swing high, swing low. So now that's a higher swing low because it's higher than the previous swing low. So we've got swing high, swing low, and that's a higher swing low. I've got a lower swing high that's lower than the previous swing high. I've actually got another one there actually. So we've got swing high, swing low, lower swing high, lower swing low. So this part of the chart here that we've just highlighted for the moment, if price then goes below that lower swing low here, then I'll be in a newly established downtrend, as this is the first point in time that price is making lower swing highs, lower swing lows. So from this horizontal line onwards, price will now be in a newly established downtrend. So this is basically the transition from long previously, which is just off the left-hand side of the chart, to a short direction bias. Price is making lower swing highs, lower swing lows. Price is in a downtrend. This is a fact that can't be denied. So again, price making lower swing highs, lower swing lows, all the way over to this point here. And again, start the process over. So what you can be doing, really and truly, the only thing you need to do is mark off the last 2 swing highs, 2 swing lows, to try and identify which phase of the market it's actually in. Now, I just want to pick up on this point here. So we've got a swing high and a swing low all on the same bar because it's an outside bar. The high-low range of the bar is outside of the high-low range of the bar before and the bar after. So this is both a swing high and a swing low all on the same bar. So we've got lower high and a higher low on the same bar. and there is the higher swing high. So again, the transition from short to long. So low, lower high, higher low, higher swing high. Now, when price is making higher swing highs, higher swing lows, generally it's going up. So from this point onwards, if price then goes above this part of the chart, it's now in newly established uptrend. So we're coming on to the point that I want to try and highlight now, which is at what point do we decide that, or what point can you identify when price isn't going to follow through with that new direction buy. So let's follow the sequence on again. So we've got, just want to draw these on for the moment. So we've got, my computer's running a little bit slow today if it's stalling. So again, high lows, higher swing highs, all the way up to this point here. So we've got high, higher low, higher high, higher low. We've got another higher high there, no higher low, higher swing high here. Now what we can see over here, at this point of the chart that I'm just about to highlight, if my computer will not freeze up on me. There we go. So we've got higher low, higher high, lower low sequence. So this is what I tend to refer to as an alternative buy change. Now the only difference between the points of the charts, what I refer to as the alternative bias change and the regular bias change, is the order in which the sequence develops. So a regular bias change, price makes higher low, for a long the higher low first before it makes the higher high, and an alternative bias change, as I'm just marking off now, price makes the lower swing low first. Once we can see here where the cursor is, price has made that lower swing low. It's breached the previous swing low on this upward trending move. So price has retraced quite dramatically, breached that previous swing low. So I've got the lower swing low first, and the lower high will typically always be developing after that. So is everyone with me so far? So we've got two types of bias changes at a basic level. Regular bias change we've just been through, and this would be an alternative bias change. The only difference between the two is the order in which we get the lower swing low or the higher swing high first. The alternative bias change, we typically get the lower swing low or the higher swing high first before we get the subsequent lower highs or higher lows. So can everyone see the chart first of all? It seems like from a few of the comments that the chart's not presenting properly. There should be several red and blue arrows and a horizontal line on the chart now. Everyone just confirm that the visuals are updating for them. So we've got where the cursor is now, alternative bias change. So in real time, let's just scroll back the chart. So in real time, what you'd be looking at would be this portion of the chart here. So price is made higher low, higher high, lower swing low. So if price then goes below the lower swing low, we'll be in a newly established downtrend. Yep. Now price does that on the next bar. So you can be thinking about, at this point of the chart, being biased to the short side. But what is occurring with, to be fair, quite a high degree of increasing frequency at the moment is what I'm considering bias change flip overs. Now these didn't used to happen with a regular degree of frequency, so they weren't too much of a concern. But given the current nature of the market over the last 6 to 8 months, again, think about what's going on in the economy. You know, a lot of uncertainty, lots of economic reports and fundamental reports coming out, changing the sway and the opinion of the valuation of these currencies between one currency and another. You know, every other day there's a piece of what is perceivably bad news, which is creating these fluctuations in price anyway. But what we're seeing again is that the market overall, if we look at the dailies and the weekly chart, isn't really trending. You know, overall price is basing out. It's been drifting sideways on most of the cross rates that I look at. Again, the list is at the top of the screen. It's been pretty much going sideways for, several months. So what we're seeing a lot of on the 240-minute chart, which is my personal higher time frame to identify the direction that I'm looking at from a trading point of view, is we're seeing this type of pattern here. We're seeing the lower swing low develop, and obviously the opposite for a short, we're seeing the higher swing high develop. But in this example, we're seeing that the lower swing low develop. It will trigger and pretty much flip over straight away. And what we'll typically see is an outside bar or an engulfing bar, hammer, doji, shooting star, these types of bar candlestick pattern formations that trigger the bias, or what I would consider the direction bias, to now being short, and then basically flip over. So this is probably the earliest point in time that you could identify that, hold on, in the short term, the direction bias might not be fully completed at this stage. It might just be faking us out and basically flipping us over. Does everyone understand the concept of what I'm trying to explain? So what we're seeing is the failure, hopefully at an early stage, of the direction bias. So although technically from the chart's point of view, the direction bias I would consider at this point of the chart as being down, as price has made a lower swing low and has breached that lower swing low, I would typically consider the direction bias as being down. But what we can often see, and again with a really high degree of increasing frequency at the moment, is when price basically triggers that direction bias and flips us over. So at the moment, what I'm now trying to consider on a new direction bias that develops, that first point in time that price makes those high swing highs, high swing lows, or the lower swing highs, lower swing lows, and when price breaches that lower swing low for a short or the high swing high for a long, I'm trying to assess this flip over that we're now looking at the hard right edge of the chart. So when I'm seeing this, I'm saying to myself, well, hold on, in the short term, price might not be ready to go down just yet. So what I'm then looking for is to think about an each way trading opportunity at these direction biases. So in this example, I'll be looking for shorts below that lower swing low. And what you can look at the time is an Asian session range. Again, we've got a small or narrow band of trading activity during the most part of the Asian session and the first part of the UK session at this particular time on the chart, is to then consider, well, hold on, the breakout to the downside has failed, it's flipped over, I've got confirmation on the 4-hour chart that I've got a flip over, and I can consider a breakout through the high of the Asian session consolidation and reconsider the direction bias being, at the very least, still up at this point of the chart. Does everyone understand the concept? So this is basically a direction bias flip, or for want of a better description, a direction bias flip over. Essentially, this is going to be the earliest point in time that we can identify that the direction bias will flip over. Any questions so far before we move on and take a look at a few more examples, and then we'll take a look at alternative use of fibs. Russell, we'll come on to that in a moment, but yes, we can ultimately think about using fibs. So, direction bias flipper. Let's take a look at a couple of examples. It's not always going to follow through, or in the short term, it might not follow through. So, what I'd be looking for then in this case would be effectively a double confirmation. Now, obviously, we know what happened with hindsight. Price has, in this case, rallied and resumed the upward trend. Now, it's not always going to be the case, as we'll see in a moment. But what I'd then be looking for, when I get this lower swing low, I'm going to use that new lower swing low there as a double confirmation for the direction bias genuinely going down. It might just be short-term rally, or we could see, as in the case of the euro on this in this chart, the resumption of this upward trend. Now let's just go through a couple of examples. So we've got a couple of examples on, again, we're just going to be looking at Aussie dollar yen if you want to follow through on your own charts. So Aussie dollar yen, 240-minute chart. Again, let's just quickly work out the price action sequence. So we've got high, higher low, another higher low there, lower high, higher low, and sorry, my trade station's just frozen up for a moment. Okay, so we've got the higher low, higher high, and we've got that lower low there. So that's what we're looking at. Okay, so what we see in the chart, at this point of the chart, we've got the high, higher low, higher high, lower low. And what we can see, let's just zoom in actually. Okay, so we just zoom in a little bit. So we've got the higher low, higher high, lower low over here. So if price then goes below this lower swing low, and again, if we think about that in real time, that's what we'd be looking at. So price made higher low, higher high, lower low movements, and we've got the lower swing low now. So we've got the lower swing low in this case first. It's again what I would view as the alternative bias change. The lower high is typically always going to be developing. And as price triggers that, we'll be thinking about shorts. But what we see over here is pretty much that hammer bar formation that's suggesting we're going to get a flip over. Well, to be fair, the blue arrow, as you can probably, the question from the room was, what does the blue arrow mean? Blue arrow means up, red arrow means down. Swing low, swing high, swing high, swing low, swing low. So I'm just marking off the swing highs and swing lows. So what we're looking at again is we've got the higher swing low, higher swing high, lower swing low. If price goes below that lower swing low, I'll be in a direction bias to the short side. That does trigger, but what we can see is we're getting an indication that price is potentially going to flip us over at this point and resume the upward trend. So what I'll be looking for in this case is price does rally. We can be thinking about a long side move or resumption of the uptrend on this the potential flip over, and I'm going to now use this lower swing low or the second lower swing low as a double confirmation for a direction bias to the short side. So whereas previously I was looking at higher low, higher high, lower swing low, price breaches that lower swing low, I'll be looking to then sell the rallies in a downtrend, or potentially I've got a flip over. Again, that's that basically the bias change triggering and then flipping over straight away. We've got this hammer bar formation here with the candlestick patterns. That basically means that I can now think about that each way trading opportunity, short side on the breakout through the consolidation that we can just see with those two inside bars there. So breakout of the Asian session range to the downside, which triggers the short direction, but as we can see, that flips us over, and I can think about a breakout through the high of the Asian session range and look for a resumption of the uptrend and a direction bias flip over. If price is going to continue to go down, I'm now going to use this second lower swing low as a double confirmation for a direction bias to the downside. And to be fair, that's what happened in this instance. So we've got a little bit of the upside movement, and to be fair, this, although it doesn't look like it, this is pretty much the majority of an average day's move. So this actually put in quite a reasonable move through the day earlier in the week. And I'm looking for that double confirmation to the downside. So in this case, we get that double confirmation. On the euro, we saw the resumption of the uptrend, and it followed through quite significantly. In this case, we saw a flip over. There's some upside potential still left, but as we can see, the double confirmation eventually triggers. Okay, so that's what I wanted to talk about, and basically just update the price action sequence. This is a pattern that's developing with increasing frequency. Again, I wouldn't need to worry so much about it down here. It's really, as we can see that similar situation here where price breaches that swing low here and then flips over to the upside. Now, if you're thinking about counter-trend trading opportunities, that could quite possibly be a counter-trend trading opportunity for you. But what I'm looking at this pattern, or this repeatable pattern here that we can see, I'm looking at it really on the, I'm looking at it really from the direction bias triggers point of view. So although we've got the same pattern developing here, this isn't alongside trading opportunities that I would have been looking at, because I'm really just looking at the pattern developing as the bias change triggers. Again, we can see that same pattern over here on the second blue square. Anyone who does think about counter-trend trading opportunities could say, well, hold on, I've got a continuation failure, because price is essentially pulling back with a lower swing low, lower swing high. Price has made another lower low movement, but then flipped over. That might provide a counter-trend trading opportunity, as we can see in this case. But for me personally, I'm not a counter-trend trader. I'm usually a with-the-trend person. So I'll wait this rally out and look to sell those rallies in the downtrend, which brings us on to using fibs. So at this point of the game, is there any questions on this direction? This is like a new addition to the bias change sequence of trying to identify when, or potentially when, that bias change on the initial trigger of the new direction shift when price, that first point in time that price makes those lower swing lows, lower swing highs, or the higher swing highs, on the trigger of that higher swing high or the trigger of the lower swing low that would usually signify a new direction change, we can see this flip over, and it is happening with a great, as we can see, with a high degree of increasing frequency. So that's what we're trying to establish. Yeah, the double confirmation then. So let's just think about the double confirmation. Now, single confirmation then, if you like, just for want of a better description. Single confirmation for me would be when price goes below that lower swing low. So we've got the higher low, higher high, lower swing low. The lower high typically always develops in this instance because the lower swing low develops first. Now what we've got here is we've got price triggered the bias change, and technically and normally in the past I would now then say to myself, I am now biased to the short side. I'm only looking for short trading opportunities. This is a newly established direction bias to the short side. What I'm saying is that when I see this flip over, I'm considering the long side and the potential resumption of the previous uptrend. Now, if price is going to continue to go down and I do genuinely see a direction bias change, I'm now going to use that new swing, that second swing low here. So we've got the lower low, another lower swing low. So on the trigger of that direction bias change on this time frame, I'm now going to consider the possibility that price could be resuming the uptrend, and I'm taking that new low as my new trigger for a short direction bias. So I've referred to that as a double, effectively as a double confirmation, because previously I would consider the direction bias as being down, but price would then need to double confirm for me by breaching that that second lower low movement, which is what happened in this example. And again, if you think back to the euro, we didn't get that double confirmation. So price would need to go below that second lower low. The first trigger was there where the cursor is on the initial first lower swing low. It triggers, flips over, you get some upside movements to the tune of an average day's move, so that's quite a reasonable movement. But for a double confirmation, or a more conservative confirmation, if you like, I'm now looking for a movement below this swing low here, just to double confirm that the bias is genuinely going down. Again, if we think back to the euro, if we just go back to the euro dollar, that didn't happen. Just go back to the euro for a moment. So go back to over here. This is what we were looking at. So we've got that lower swing low. Price triggers the lower swing low. We get the flip over, and we didn't get that second breach of that lower low movement. In this case, price resumed the uptrend. So that's what I mean by a double confirmation. So initially, price needs to go below the lower swing low. If we get the flip over, the hammer, the doji, the shooting star, depending on where it's developing, I'm then looking for price to move below, in this case, that second lower swing low, or just the opposite for shorts, the higher swing high. That's what I mean by the double confirmation. Right, okay, so I think we've nailed that one down. So when to try and identify when the direction bias is going to flip you over. Basically, we're looking for that lower swing low or the higher swing high to trigger, and on that trigger bar on this time frame, which is for me the 240-minute chart, I'm looking for that hammer, doji, shooting star, a rejection bar for that direction bias to trigger, and that's going to give me an indication that, hold on, this bias change might not be ready to trigger just yet. It might be that we like to see on the euro here, where the resumption of the uptrend continues, or it might be I need to wait for that double confirmation as we looked at on the Aussie dollar yen, where it flips us over. We do get some upside movement, and then the genuine direction bias starts to kick in. So that's what we're looking for. So let's think about fibs for a moment in the last part of the session. So I just want to go to my main. Let's take a look at the 60-minute charts. Take a look at my main setup. So I'm looking at 60-minute chart of the pound yen. So let's just recap first of all the fib retracement strategy. Let's recap the fib retracement strategy. The first thing with fibs is to identify a thrust move. Now, thrust move is very simply trending price action. what I'm trying to identify is first of all the direction. So usually, as we know, it's check out the direction of the 240-minute charts. We've just been through that for the last 15-20 minutes on the 240-minute chart. So the direction bias, for example, is down. I'm looking for shorts. I'm looking to sell the rally in a downtrend and buy the sell the rally in a downtrend, buy the dips in an uptrend. That's the whole purpose of identifying that direction bias. So if the direction bias is down, sell the rallies in a downtrend and sell the breaks of support through any Asian session ranges. So if the direction bias is down, I'm looking to take fibs from swing highs to swing lows and look for retracements. So fibs from, for me, it's usually current day's highs, current day's lows, or previous day's highs, previous day's lows. For the fib retracement setup, again, there's a recorded session on this, so I'm not going to go over the details. So I'm not going to go over the strategy in too much detail for the moment, but I'm essentially looking to take fibs from current day's highs down to current day's lows and look for at least a 50% retracement. Entries usually either on the 15-minute chart or with a bias change on my lowest entry time frame, which is an 89-tick chart. If you don't have an 89-tick chart, a 2 or a 3-minute chart will give you a similar effect. So I'm looking for a move up to the 50, close below the 38s on the 15-minute chart usually. Appreciate we're on the 60-minute chart for the moment. Or a bias change on my lowest entry time frame. That's my usual fib retracement strategy. Now let's think about what happens, because again, what we're seeing a lot of at the moment is we're seeing a lot of Asian session trends, a lot of Asian session movements. And for me personally, you know, if a move happens at 2, 3, 4 o'clock in the UK morning, I'm usually tucked up in bed. That's not an option for me, because the strategy, the way that I apply it with the fibs, is I need to be at the screen. So how can we achieve trading, or how can we achieve looking at fib retracements when we're away from the screen? Well, first off, the one that I've highlighted for the moment is this developed at about 7 o'clock in the morning. So this, is perfectly tradable from a time point of view. From my perspective, this is usually when I'm at the desk anyway. So fibs from previous day's highs to previous day's lows, move up to the 50, close below the 38, and the bar that closed below the 38% retracement is the trigger bar for the entry, with an entry below the trigger bar. And again, the fib retracement strategy has been recorded. Appreciate on the 60-minute chart. Usual entries would be on the 15-minute chart. So that's the regular strategy. Now let's think about when price got up to and made the high of the day here. This movement happened for me, UK hours between about midnight UK hours. I'm on GMT +1 for anyone who doesn't know. So this move happens pretty much as I'm tucked up in bed. So how can I potentially capture these movements? How can I potentially get on board some of these retracements? We'll look at a few. First off, let's look at the pound yen. So just scrolling back along the charts, typically I call it a day between 4 and 6 o'clock UK hours. So around this portion of the chart, this is typically when I'm wrapping up the session and not thinking about new trading opportunities. From a fib retracement point of view, I've got a counter trend movement, so I'm going to take fibs from previous day's highs down to current day's lows. Again, I've got a counter trend movement, and I'm looking for at least a 50 or 61% retracement as long as I am at the computer to be able to physically wait for that trade to set up. But what if I'm not at the computer when these things develop? What if we see a movement that develops overnight? Now, this is a little bit vague from the point of view of specific entry setups and requires the use of using a limit order to sell. So if I'm looking for price to retrace up to the 50 or 61% retracement, where's going to be a suitable location to try and identify a selling point on the chart? Well, what I'm looking for in this case is I'm looking now to place an order at a 50 or 61% retracement that lines up with previous day's low. So looking back across the chart, we can see I've got the previous day's low here. So these solid red lines, these are previous day's highs and lows on the chart. And what I can see is that I've got price action support at 146.30 and the 61% retracements. So if price continues to retrace overnight or during the Asian session, I could place a limit order just ahead of that 61% retracement. Now in this case, what I personally did last night was place a limit order at 46.20. with quite a wide stop loss. In this case, you're not typically going to place 30 or 40 point stop loss sizes. You're looking really in excess of, perhaps, 50, 60, 70, 80, depends on the cross rates. On the pound yen, this is a little bit more volatile. So I'm going to need quite a wide stop loss to try and take into account the possibility that we could see some shoot through or follow through that 61% retracement. In case it just doesn't get up to that 61% retracement level and the previous day's low, I'm going to need quite a wide stop loss to try and take any further advancements in price, because you're trying to ascertain where that turning point will be without actually watching that turning point develop. So you're looking realistically at quite wide stop loss sizes to try and capture these types of movements. So entry orders will be on a limit, and as we can see, what price actually did. But we can see that the 61% retracement in this case lined up with the previous day's low. Now, this is a strategy I used to use way back in 2004, 2005. If I was having to step away from the computer, this is something that used to regularly occur. And what we're seeing is this pattern develop quite a lot during the Asian session. So what I can do is, late on in the UK evening, place that limit order to sell ahead of the previous day's lows, and in this case, the 61% retracement. So I'm looking at previous day's highs, yesterday's current day's lows, and I'm basically looking to anticipate price getting up to previous support, which should act as resistance that lines up with a fib. So I'm looking for a confluence of events of previous day's lows or previous day's highs for the opposite direction trade, and that fib retracement level, placing a limit order in this case to sell just ahead of that previous day's low, somewhere around about 46.20, 46.25. But we're going to need wide stop losses, so it's going to be reduced position size to try and take that larger stop loss size into account. Now, coming into the next day, what you can obviously do is then refine that stop loss location back down to something more sensible, which is past the event. So if you've got an entry at 146.20, you're going to end up with a stop loss at around 146.50 when you refine that, and you can physically say, well, hold on, I don't need that 80, 90, 100 point stop loss size now. I can bring that down to 30, 40, 50 points because price action has shown you where that can go. This making sense? So this allows me to basically put that trade on when price is around about here, for example, 6, 7, 8 o'clock in the UK evening. Put that limit order to sell in at the fib retracement levels. So in this case, I'm looking to sell the rallies in a downtrend, so it's going to be a limit order to sell, reasonably wide stop loss size on reduced position size, and basically shut the computer off, come back the next day. So it allows you that time away from the screen to put those trades on. Let's take a look at Aussie dollar, Japanese yen in the same way. So Aussie dollar, Japanese yen, same story. So it's going to be fibs from, again, if we were looking at the chart yesterday, about 4, 5, 6 o'clock in the UK evening, fibs from previous day's highs, current day's lows. We've obviously got quite a nice trending movement. And what I'm looking for is this 61% retracement is lining up again with that previous day's low. So I'm looking at around 72.90 for a stop loss. Oh, let's just calculate the fibs properly. So I'm looking at around that 7300, 7290, 7300 stop loss limit order to sell location. Again, quite a wide stop loss size to try and take into account with reduced position size. To be fair, SUS or SUS, timeframes is pretty irrelevant with this strategy because you're not physically going to be at the computer to watch the trade set up and develop. You're not going to be looking at waiting for, because if you're around at that time of day, you might as well wait for price to get up to these levels and refine the entry and get the position and trade management correct, and wait for price to turn around. But what I'm saying is these moves happen to me at midnight. I'm tucked up in bed. I'm not physically at the computer at that particular time of day. So I'm looking for a previous day's, in this case we've got a nice thrust trending move, price is retracing. The direction bias, as we know, is down on the 240-minute chart, so I'm looking to sell the rallies in a downtrend. I'm taking fibs from previous day's highs, current day's lows, and I'm seeing that the 61% retracement in this case lines up with previous day's lows. So I'm looking for a confluence of events, previous day's lows or highs for longs, and a 50 or 61% retracement. So I'm looking for that confluence of events. We've also got an additional confluence of the psychological support resistance level, which is the 7300 round number. So I'm looking to place a limit order to sell just ahead of that previous day's lows, anticipating that price is going to, that previous support is going to act as resistance with the confluence of the fib retracements. So I'm going to place a limit order to sell and shut the computer off and walk away. But what I need to do, because I'm not refining that entry, I'm not physically sitting at the computer to refine a trade entry, to try and pick the moment that's going to offer me the best trading opportunity with the right risk and the correct position size. I need to have quite a wide stop loss size to take into account any follow through that might develop. And if we take a look at Swiss yen, this is an example of one that did follow through and basically stopped me out. So Swiss yen, we have that fibbed from previous day's highs to lows again. And I just got the management slightly incorrect on this one. So in this case, I have the 50% retracements. The 50% retracements at that previous day's low. So 50% retracements at the previous day's low. So basically, I've placed a limit order to sell just ahead of the previous day's low at 86.70 and placed my stop loss just above that 61%. I thought that was personally going to be fine. So in this case, it got me in the trade, stopped me out, and then went on without me. And again, because I'm not at the computer, I should really put a wider stop loss on it, but I thought, well, that's quite sensible. It's a lesser volatile cross rate, and this is the one that stopped me out. So a little bit too tight on the stop loss placements, so it stopped me out, and again, I've missed out on this movement. But hey, I've got some of the cross rates, so I can't complain too much. This instance, it stopped me out. So that's, again, just to highlight the danger of putting a stop loss too tight. I just got it slightly incorrect. I've had it a little bit too close, and I missed out on the movements. Dollar yen. Let's take a look at dollar yen then. USD JPY. This isn't for those of you who know me, this isn't a cross rate that I like to trade personally. It's just a personal hatred of the dollar yen. It's nothing practical other than I don't like to trade it. So let's think about the same philosophy then. So looking at previous day's lows here. So first off, I'll start with previous day's highs, previous day's lows. And we can see that 61% retracement lining up nicely with the previous day's lows. So there you've got the 61% retracement in this case at 96.10. So you can basically just put an entry, a limit order to sell just ahead of that. Before you go to bed, there's a nice little setup. 50-point stop loss size would be probably suitable on the dollar yen. Again, that's quite wide in my view for the dollar yen for this type of strategy. Say 9600, 50-point stop loss size, still well inside of risk tolerances. Shut your computer off, go to bed, get up the next day and see if it worked out. It's a little bit, this is what I was saying earlier, it's a little bit loose on the description, but what it allows you to do is you well in advance, you're working out your risk management, your position size, you've got levels. You're just not physically able to be at the computer to be able to wait for the trade to set up to see if it gives you an entry condition, limit order to sell, fixed stop loss size. It needs to be quite wide, so you're not going to be using, your full position size on this in most cases, particularly on some of the more volatile cross rates. But it allows you to not spend 24 hours a day at the computer. What have we got? Let's just go back and look at dollar yen over here. So we've got previous day's lows here. So let's see if we can get some fibs. So we've got start the move down to the end of the move there. So you're looking at previous day's highs and lows first of all. So you've got that between the 50 and the 38% retracement there. So this is one that possibly would not have, again, I don't trade this one personally. So previous day's lows, I've got a 38% retrace, or between the 50 and the 38% retracement there. 50 and the 38% retracements. You'd be looking at a limit order to sell about 97.90, just ahead of that previous day's lows and the fib retracements. So this is one that would have not got you in the trade on that philosophy. So you're looking for movements up to that 97.90, just ahead of that previous day's lows over here. Again, price didn't quite get there, so again, that's a move that you would have missed out on. So you're not going to get them all. Sometimes you're going to miss them. Sometimes you'll be stopped out because you're not physically at the computer to try and refine those trading opportunities, those trade entries. So again, these are good, a nice alternative view of using fibs, looking for a confluence of previous day's lows, fib retracement setups, and trying to take into account potential movements or potential entry that would develop while you're in bed or while you're away from the computer or while you're in work. These are things that or this is a pattern that used to work out really well for me. 2004, 2005. It was something that I could put on and literally walk away from, even during the regular session. Prices moved, prices retracing, waiting for price to get there. I've got to go and run some errands, place a limit order to sell, slightly wide stop loss size to take into account the volatility, and the price might shoot through the level before turning around, and come back and see if it worked out later. Again, appreciate it's not my usual specific, this is the entry, this is what I'm waiting for, this is what I need to see happen, and this is what I need to see develop. Then I'm going to place this order specifically at that level. My stop loss is specifically at that location. That's the way I like to deal. So I appreciate this methodology is a little bit vague and loose around the edges, but due to the nature of you not being at the screen to be able to refine those trade entries and management, this is the next best thing to try and take into account these overnight movements that are developing for me. Looking for fibs from previous days highs to lows, looking for another previous day's low to line up with a fib retracement level, and placing limit orders to sell or limit orders to buy with a suitably wide stop loss size. You don't want to put it too close, as I highlighted on the Swiss yen. I basically put a 35-point stop loss in. With hindsight, it was far too tight. I should have put a 50-point stop loss. I don't know what possessed me to put 35-point stop loss in, but I should have put something more reasonable, like a 50-point stop loss size on the Swiss yen. In that case, it stopped me out and didn't participate in that movement. FX clans, yes and no. Yes and no. They do and they don't. It's nothing personal. They're not. If you think about so the question for them was, do stop loss exist? Yes and no. It's nothing personal. They're not hunting for you specifically. If you think about money flow or order placements, this is something that Sam talks about quite a lot. Order flow and money flow movements. Where are the orders? Where's the money flow? If a particular bank or a particular institution is looking to position themselves on a movement or fulfill an order for a client, then they need liquidity. The most logical liquidity is where everyone's stops are. So if they're looking to sell, people are short, rally price up as much as they can to where that logical stop loss location is, so they can start selling into those buy stop loss orders or buy into those sell stop orders. That's what they're doing. It's nothing personal. They're just trying to fill an order. Does the risk reward justify this? I think it's going to have to be the last question, folks. Does the risk reward justify the wide stop loss? To be fair, if you're looking, what you're trying to do, I mean, the way that I use fibs and the fib retrace, you're looking for the main move. What I'm looking for personally is the main move of the day. If this is going to be the high of the day, if that's going to be the high of the day overnight, and to be fair, look at the pound yen. Pound yen, that was the high of the day. That's what you're trying to identify. You're identifying the potential high of the day. Fibs from previous days highs to lows, previous days low lines up with a 61% retracement, limit order to sell at 46.20. The high was there was 46.43. So you're within 20 points. To be fair, you're within 15 points of the high of the day. What you've just identified is the potential high of the day. And it's done 83% of an average day's move. So if you're in from 46.20, prices move down to 43.50. You're looking really at capturing the higher days. So of course the risk rewards, is worth it, because you're getting the higher of the day, and there's the potential for 100% of an average day's move. In this case, so far it's done about 83% of an average day's move. If you're looking at risk rewards from a fib extension, instead of looking at an average day's move, if you're looking at the fib extension, same location as what you've taken the fib retracements, the height of the move, start of the move to the end of the move, the same locations that you used for the fib retracements, and add that distance to the start of the next move down. So from a fib extension point of view, you've now got the potential down to 141.70, which is obviously in excess of an average day's move. So of course you've got the potential. The risk reward is certainly worth it. You're risking 80 to 100 points in its 46.20 down to 40, nearly 4,200 nearly. 450 points. Still 4-to-1 risk reward rate with a 100-point stop loss. It's still 4-to-1 risk reward ratio. So of course it's worth it. Right, folks, any final points? I think we're going to have to wrap up now. But I think that's me done for the day. So just quick roundup. We've looked at the price action sequence. We've looked at how and when to identify when price will potentially flip you over on that direction bias change. The earliest point in time that we can identify, well, hold on, this direction bias might not be genuinely triggering just yet, and when to look for that double confirmation and resume the previous direction bias. That's what we've looked at. We've also looked at an alternative use of fibs. Appreciate it's a little vague around the edges, but we can identify those locations that will be good to potentially sell the rallies in downtrend, try and take into account those overnight or Asian session trends, or even if you're just simply away from the screen for an extended period of time. Again, this is still a reasonable method. Don't place your stops too tight. You need to try and take into account the potential for follow through beyond the levels that you're looking at selling into. In this case, there wasn't too much follow through on the previous day's lows and the 60 and 50% retracement levels. On other occasions, there will be some follow through, so you need to try and take into account the volatility on the cross rate that you look at and have a suitable and sensible stop loss. Don't use a 30-point stop loss size on the pound yen, folks. I wouldn't use, it's very rare that I end up using that, even when I'm looking at scalpers entries. Have something sensible that reflects the cross rates volatility that you're looking at. On the pound yen, you're looking at really in excess of 80 to 100 points. Euro, 50, 60 points would be suitable in my view. But again, try and take into account the volatility. I'd rather put reduced position size on with a wider stop loss size than put more position on with a smaller stop loss and be stopped down. So keep that in mind when you're thinking about this methodology. Again, I appreciate it is a little bit loose around the edges compared to my usual specific, this is what we do, when we do it, and why we do it approach. But if you're not at the computer, you don't have that luxury of looking for those specifics. So 2 main points today: bias change flip overs and trying to apply the use of fib retracement levels, looking for those confluent zones to try and identify trading levels and how to participate in a movement while you're away from the computer or during an overnight or Asian session trend. That's what we're trying to identify. With the method, you're trying to identify highs and lows for the day, and usually they line up quite nicely. Again, this is another increasingly and frequently occurring pattern that's developing at the moment in the same way that those bias change flip overs are developing. Apart from that, folks, that's me done for the day. If you've got any questions, comments, please feel free to get in touch with me through the blog, or you can contact me directly through my own website. I'm sure if you do have any questions, I will be able to answer those for you. But apart from that, folks, that's me done. My name's Philip Newton. You've been fantastic, and thank you very much to FX Street for holding this session for me.